Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is the weekly my thoughts on market happenings for August 20 in 2021. So it's been a losing week with all the major indexes down for North America, and we just had a positive Friday momentum into the next week. So, in many ways, the markets become addicted to the US Fed's liquidity. And so, any mention of any tightening is cause for a market pullback. There is also a fear of stagflation, which is inflation and slow growth put together, despite all of the spending that is happening in the US. Overall inflation, which has been a concern for several weeks, is also still in everybody's mind. So inputs are staying high. They're causing shortages and slowing sales in anything that needs semiconductors, for example, and this is along with the slow growth. Canada's consumer price index rose 3.7% annually in July. This is the highest reading since 2011. This is driven by the supply chain bottlenecks, higher energy prices, and rising housing costs, as per Statistics Canada. Economists had forecasted that inflation would jump to 3.4% from June's 3.1%, marking the fourth straight month inflation has come in above Bank of Canada's target. However, central bank has warned against overreacting to the temporary spike, although it doesn't expect inflation to return to its 2% target until 2024. So the temporary inflation seems to have now been extended to about 3 years. The US Fed is in the process of quote unquote putting away its tools designed for actual emergencies. So the US Fed is also thinking of slowing down the economy a little bit. Now, next week is a big Jackson Hole meeting for the US Federal Bank, and we're not really expecting much news from there next week. The tapering of bond purchases, which affects mortgage interest rates and money supply and liquidity in the bond market, is already built into the market, and US interest rate hikes are still down the road. I am still expecting Canada to increase interest rates before the US does. We've also gotten reports of slower growth in China, where they reported an 8.5 growth rate versus an 11.2% growth rate that was expected. So this is obviously concerning because they're not growing quite as fast as they thought that their economy would, and that is obviously a concern. The investors are fearing just general slowing global growth. Now, the D variant of COVID is causing fears of slowdowns as well and rollback of travel, which is in turn causing oil drops, but is hoping not to derail growth. The deaths in the US are increasing, but not as fast as the infections, showing that vaccinations have had a positive effect. The worries over the Delta variant would likely lead to a reduced consumer spending, and things like dining, travel, and some other services would likely decline, even though economists are expecting the drop to be modest and brief. There was an announcement of a Canadian federal election. The election day is on September 20th. I suspect this was announced because polls indicate that Liberals could actually win a majority. And the things on the political agenda that could affect investors are things such as uh, a move to a 75% capital gains inclusion, coming up from the 50% capital gains inclusion that we have right now. And something that's been talked about for a while, but which I think would be political suicide, would be taxing the sale of primary residences. We also had a climate change report come out and saw that there could be significant additional costs due to weather damage, whether it's storms and rain and so on. We are also expecting an increase in Canadian bank dividends, which have been on hold for a while. And the increases are expected to be in high single digits to low double digits, which is great news for anybody who owns Canadian banks. And this is expected to happen in the second half of 2021, potentially just towards the end of 2021. There could also be share buybacks. Most of the companies that I follow have now reported their second quarter financial results. And aside from some headwinds due to strength in the Canadian dollar, the results were strong and largely better than expected. So that was mostly good news. Turning back to the US stock markets, which quite a few experts think are a little bit frothy. The forward PE of the S&P 500 is just 21 times earnings. So it's definitely not cheap, but in an environment of rapid growth, high corporate margins, and low interest rates, some experts think this is not outlandish. So the market is definitely not cheap, but probably not overvalued at this point. The July retail sales data came in. They were released on Tuesday morning, and they showed an overall sign of a more reluctant shopper. Retail sales in July fell 1.1%, slumping below the Dow Jones estimate of 0.3% decline in US retail, and dropping below the upwardly revised 0.7 gain in June. Most of the declines came from motor vehicles and parts dealers, but consumers also backed off from purchases at clothing stores and shopping online. Shoppers seemed content to spend on dining out, however. Eating and drinking establishments in the US had a 38.4% increase in sales compared to the previous year. So that concludes my thoughts on the markets and investing this week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.